Hey guys, welcome to Investing with JYK, and today we'll continue on the series on basic investing, and this one will be just on some basic accounting, and this will be just on part of the income statement. So accounting really that the part that's of interest to investing is just the three statements and some of the explanations in the report. And the three statements are called income statements, balance sheet, and cash flow statement. And we will look at the income statement today. So, does this go? Yes. Okay. So yeah, so we'll use Walmart's 2017 annual report as an example. Walmart, for such a big company, actually has very simple statements. They're simple, but things that goes on in the business is anything but simple. They kind of just coalesce a lot of items together, which makes it easy to, well, at least to explain. And okay, so let's actually first look at the income statement here. Here you got Walmart's consolidated income statements of income, they call it. And you can see you got the revenue, and you have total revenue, and then there's cost of sales, and then you have operating costs, also known as SG&A. You have operating income, and then you, from the operating income, take away the interest you pay on the debts, and then the other thing you have to pay, the capital lease, and which is basically, for example, the building that they're in sometimes is leased. That's a capital lease. And you have total interest payment, and then some other kind of loss, which is one time. So extinguishments of sale, basically someone owed them some money, and then that someone might have gone bankrupt or something, so they couldn't no longer get this money back, or they just forgave the debt on somebody. So this there might be an explanation, but for now it's not too big. So let's just say these are only millions, so that's like $3 billion. And if you keep going down, then you have taxes, and once you go beyond taxes, you just end up with net income. And this line, which is net income attributable to non-controlling interest, is basically if Walmart formed some kind of joint venture with someone else, and Walmart has a controlling interest in that joint venture, so basically Walmart calls the shots, the revenue gets 100% accounted towards Walmart, and the income also gets 100% accounted to Walmart, and that goes in here. But then, because it's a joint venture, the other equity holder is entitled to some of that gain, so that is accounted here. So you basically just subtract the portion that's supposed to be given to the non-controlling parties. So then that you end up with the net income, and you divide net income by the number of shares. You end up with just earnings per share. That's quite simple, and here they tell you exactly how many shares they have outstanding. And the bottom, that's really dividend, but that usually this doesn't come in income statement. But all the accounting thing is fairly discretionary. You can, so long as you tell most of the story, you can put things in different places, and you can um, you know, put dividend here if you want. Now, so let's go through the most important line items. So first, revenue. So revenues, it should be quite simple, but it's not. It's basically how much stuff you sold, right? So if I sell a hamburger for $5, my revenue is $5. My earnings not 5. Everybody knows that because I have costs. I have to pay for the hamburger. I have to pay for the electricity or gas that is used to cook the hamburger. I have to pay for the venue. So basically, my restaurant has rent. My restaurant also has depreciation. The house, the building doesn't last forever and all that stuff. So the revenue is just how much I sold things for. Here I specifically didn't say how much money I collect because in accrual accounting, those are not the same things. So for example, if I sold a car to Joe, and Joe promised me that he shall pay me back in 3 months. I get to account that sale as revenue, so long as I'm reasonably sure that Joe will pay me back. Obviously, if Joe is a well-known fraud, then I probably shouldn't put that in revenue. So a lot of times the selling and the collecting of cash are two separate events. And what revenue says is how much I sold things for. And for consumer-facing things, typically selling and money collecting are exactly the same thing. So if I go to Walmart, I buy something, I immediately pay Walmart. There is no receivables. Walmart does not extend me a credit line, basically. So yeah, so that's revenue, and then things we have to pay attention to in revenue is channel stuffing, which is this is, if you think about it, if you have a business-to-business sales, typically they have a payment term. So you sell things to your client, and then they pay you in a certain amount of time. Typically, there's like 30 days, there's 60 days, there's even 90 days, there's even 120 days, depending on the terms. And sometimes when your client is especially non-trustworthy, then people ask for cash on delivery. So that leaves a window for companies to play games. Channel stuffing is basically the company will sell more stuff to their distributors than the distributors can reasonably sell to the consumers, boosting one-time revenue. So think about how that works. So imagine if you have distributors that can sell 100 pencils every month, or every quarter, let's say. And then this particular quarter, I want to hit some, me as the CEO of the pencil maker, I want to hit some sales numbers. So I say, oh, salespeople, go sell these distributors more pencils. Just make it happen. So then the sales people will pull out some kind of trick and then basically convince, or sometimes not even convince, just directly send the pencils to the distributors. So maybe they will give them 130 pencils. Okay, so now the problem is that, yeah, you get a one-time boost. Now your pencil sale is 30% higher. But two things. One, you don't get to collect the money because the distributors won't pay you if they can't sell their stuff. They will just return you the pencil. And the other thing is, how are you gonna keep it up, right? Because you already now sold 130, so next quarter, what are you gonna do? Another 30%, so you now do 160 something, right? So the channel stuffing just get worse, and eventually those additional inventory will be returned from the distributor back to the maker, and then the maker then takes a huge loss. And then the thing that is somewhat telling is receivables, but that's one line in the balance sheet. So receivables will go up because even though the company claimed we made a lot of sales, they were not able to collect money because in the end the consumer will only buy 100 pencils per quarter, and that's the cash that will be available to the distributors, which will be available for the distributors to pay the pencil maker. So that's that. Some of the examples in here is Valiant Pharmaceuticals. They have now changed name. They're now called like Bausch Healthcare or something. But it was a fairly infamous company, and they had all kinds of problems, and channel stuffing was one of them. And the other one is Green Mountain Coffee. I think this one was discussed in one of the books that I don't no longer remember, but there was a case in one of the books. Essentially, Green Mountain Coffee was sending their K-cups to anyone, and it was either on very loose credit terms or they were just forcing it to the retailers, and eventually the retailers gave back all their all the unsold K-cups, and then Green Mountain was almost bankrupt, I think. And the other thing is loose credit. So for Walmart, it's quite clean in a sense that if you go to Walmart to buy something, you swipe your card, the money is already taken from you to Walmart. The money could be your checking account or what the bank lent to you, which you then use to pay Walmart. But in any case, Walmart has no more involvement with you, so that transaction is basically closed between you and Walmart. But for certain companies, it's not true. Car companies like Ford or GM, they sell you a car, they also provide you financing. So even though they sold the car to you, you still have to make the payment along the way. So that is one place where things can get messy. And for example, in this case, Signet Jewelers, which owns a lot of low-end jewelries, well, low-end jewelers, like I think Kay and Jared and whatever. So what they do is they target people that can't really afford diamonds, and at least not with a single payment. So they basically let them do installment payments on these jewelries. And when things went a little bad in 2006 and 2016 and 17, that part kind of blew up because they lent to people that don't really have good income. So they just stop paying, and same problem here, their receivables will grow quite a bit. So yes, revenue, even though it should be the cleanest way of looking at the company's income, it is still subject to some kind of manipulation. So you have to watch out for those. And the next line that's important is cost of sales. Very simply, it's how much does it cost me to sell each individual to sell that particular item. So it really depends on the company. There is a lot of discretion involved in here, but let's take the example of Walmart. If they sold let's take the example of pencil again. They sell a pencil to you. The revenue is whatever that's written on the sticker, the price tag, and the cost of goods sold is first of course it involves how much money they have to pay to the supplier of that pencil. So that's one. But on top of that, how much money does it cost for Walmart to transport that pencil from their distribution centers to their stores? That's another thing. And on top of that, maybe it also involves things like credit card processing cost, because that's directly attributable to that particular sale. So those are the things. In fact, Walmart discusses that themselves. So if you search for cost of sales, they actually explain here. Cost of sales include actual product costs, which is the part they have to pay to the suppliers, the cost of transportation to the company's distribution facilities, so from facilities, stores, and clubs from suppliers, so basically the transportation costs from suppliers to the company, the costs of transportation from companies' distribution facilities to the stores, clubs, and customers, and the cost of warehousing of this for the Sam's Club's segment import distribution center. So basically a bunch of transportation costs. And so it makes sense. I mean, it is arguable. You can also say that my cost of sales only is the product cost, and I insist that my cost of transportation is overhead, or but it's hard to in this case it's very hard to spin that story. But for example, in auto industry, cost of sales would include research and development for that car model. But for Tesla, they don't do it. But that is also allowed it's just a industry convention, right? So there is really no governing body that says you have to do it that way. And next thing is gross profit. So gross profit is very simply just revenue minus cost of sales. So that would be where are we? Just go back a bit. Yeah, so you basically just do total revenue minus cost of sales. That's your gross profit. And gross profit itself is not as interesting, but gross margin is very interesting. It's basically how much does it cost you to sell each to make $1 of revenue. If it costs you more than $1 to make $1 revenue, then you have a gross you have a negative gross margin, which means the more you sell, if things stay the same, you don't get any other kind of benefit from selling more, then the more you sell, the more loss you make. A high gross margin, when everything else is held constant, basically means that the company has a little bit of pricing power. So that's one thing that you need to watch out for. And the other thing is whenever things don't do so well, for example, when retailers can't move their stuff, they would run promotions and gross margin would suffer. And then the next one is SG&A. SG&A is anything that's not directly included in cost of sales, at least in Walmart's case. So in the Walmart's case, it includes research and development, which they don't actually break out. In here, you don't see R&D, but they just include it in SG&A. And the other things are like salaries you pay to accountants, the salary you pay to human resources, your headquarters lease, and maybe a bunch of other things. So anything that does not, and advertising, for example. But some people would even include advertising. Well, actually, no. Advertising typically just goes into selling, right? And then yeah. So that's that. And so ideally, what should happen in a growing business is that the SG&A line should hold steady. So where are we? Here. This line should be relatively steady. And then you grow the revenue and either keep the gross margin by keeping the cost percentage of the cost of goods sold to revenue the same, but keeping the gross margin intact, or even increasing gross margin. In that case, your gross profit will increase, but your SG&A would be steady, which means your operating income would go up. So that's typically known as operating leverage. And it kind of makes sense too. You think about it as a economy of scale, right? So you have one accountant which might be able to handle, for a single accountant, it really isn't too much different if you had 10 million sales or 20 million sales. They're about the same because most of that is automated anyways. So your cost on the accountant side doesn't go up, but your gross profit goes up. And next one is interest. Very simple. It's just the interest that a company pays on its debt. And sometimes it also includes, in this case, you got these capital lease things. So those are, I'm not quite sure, they might explain, but I'm guessing it's, let's see. Yeah, just leased stores, very likely just leased stores. Leased stores or equipments, those have long-term commitments. And yeah, so that's quite simple. And taxes is quite simple too. That's how much money they should pay to governments. And then you got these miscellaneous items. In this case, in Walmart, there is this line that, oops, let's find it. You got this line here that says loss on extinguishment of debt. Not exactly sure what that involves. Yeah, not quite sure what that involves, but typically these are like one-off items or miscellaneous things, and they also include like currency fluctuations, when how much currency exchange rate impact the earnings. For example, if your well, that wouldn't be here. Hold on, sorry. Let's see. No, that wouldn't be here. So that's wrong. Restructuring, for example, if you laid off people, or if you had some other sold a piece of your business and whatnot. the cost of selling or buying another, well, buying wouldn't be here, but if you sold a business and then the cost of selling would be accounted here. So basically, these are known as non-operating costs. These are not supposed to be recurring, and anything recurring should be in the operating part. So if you see that everything here, anything above this line is above operating income line is the operating part of the income statement. You have revenue and you have cost sales and you have SG&A. Those three things basically make up the operating part of the business. And as long as the non-operating part aren't going crazy, you don't have to worry about those too much. Obviously, debt, you look at how much interest they're getting, they're paying compared to their operating income. In Walmart's case, it's very healthy. Their debt is total debt is $2 billion, and their operating income is 10x that. So there's no worry about them going bankrupt. But if those two lines are very similar, then you potentially have to worry. But that obviously has to depend on how much cash the company has. So yeah, so that is mostly it for the income statement. Next time we'll get a bit more into the balance sheet, and we'll go through most of those lines and all the important lines there. So yeah, click like if you like it, and leave me a comment if you want some things explained. I'll try to do my best to explain those. And see you next time.